The number arrives on a Tuesday, not a Monday, because Mondays feel dramatic and the CRA does not do drama. They do math. It appears in your online account as a single line. Balance owing $178,432.11. And for a moment, you actually laugh. You think it's a glitch. You think someone typed an extra digit. You close the tab. You make coffee. You open it again. The number has not moved. It never moves. That is the point. Welcome back to Canada Property Watch. In our last investigation, we broke down how the HST self-supply rule transforms a builder or investor into a tax collector the moment a new residential property is first occupied, and how thousands of Canadians have received six-figure reassessments from the CRA simply because they didn't file, didn't know, or were told by the wrong person that they didn't have to. If you haven't watched that video, it is linked and it will change how you think about every property transaction you've ever made. Today, we go one level deeper, because the reassessment is not the trap. The reassessment is the announcement. What comes next, the lien, is the trap. And unlike the reassessment, the lien does not wait for you to respond. It does not care whether you agree with the number. It does not require a court order. It simply locks. And once it locks, your property becomes something entirely different from what you think it is. Let's establish exactly where we are in this story. You built a property, or you converted one, or you purchased a pre-construction unit and assigned it before closing. And somewhere in that process, the CRA determined that HST applied to a transaction you either didn't report or didn't remit. They issued a notice of assessment. The number was staggering. You called your accountant. Your accountant called their colleague. Someone said, file an objection. Someone said, this will take time. And while everyone was talking, the interest meter was already running. Under the Excise Tax Act, arrears interest on unpaid HST begins accruing the moment the tax was originally due. Not the moment you received the notice, not the moment you disagreed with it, the moment the obligation existed. So every day that passes between the original due date and the day that balance is paid in full, the number grows. Not metaphorically, mathematically, compounding daily, at a rate tied to the prescribed interest rate plus an additional percentage for arrears. If the original reassessment was issued for a transaction that occurred 18 months ago, you are already carrying 18 months of interest on a six-figure balance. And if this drags through an objection, through an appeal, through years of administrative process, the number you eventually have to pay will be materially larger than the number that shocked you on that Tuesday morning. But here is where the story shifts from painful to catastrophic, because the CRA does not need to wait for any of that process to conclude before they move against your property. This is the mechanic that almost no one explains clearly, and it is the mechanic that destroys people who believe they are protected by the objection process. Now, when under the Income Tax Act and corresponding provisions in the Excise Tax Act, the federal crown has the authority to register a lien, technically referred to as a charge or encumbrance, against real property owned by a tax debtor. The legal foundation for this is found in Section 316 of the Excise Tax Act, which allows the CRA to use the collection mechanisms available under the Income Tax Act when dealing with unremitted GST/HST. And what those collection mechanisms include is the ability to register a certificate of the debt in federal court. And once that certificate is registered, it operates as a judgment. It becomes a charge against any land the debtor owns in the province where it is registered. Without a trial, without a hearing where you present your side, without a judge weighing the evidence. The debt is certified, knows the certificate is registered, and the charge attaches to your property. That is the lien. That is the lock. Now let's talk about what that lock actually does to you in practice, because this is where the theory becomes financial suffocation. Your property, the moment that lien is registered, is no longer freely transactable. If you attempt to sell it, the lien will surface in the title search conducted by the buyer's lawyer. No buyer's lawyer will allow their client to close on a property with a federal tax lien attached without that lien being discharged at or before closing, which means the proceeds of your sale will be directed automatically, mechanically, without your input. to satisfy the outstanding balance before you receive a single dollar of equity. If the lien is larger than your equity position, until you walk away from the sale of your own property with nothing. If the lien plus selling costs plus remaining mortgage balance exceeds the sale price, you walk away owing money on a property you no longer own. This is not a hypothetical. This is the documented outcome in cases that have moved through the Canadian legal system. In one case referenced in our Part 1 investigation, involving a Brampton property and a Section 316 certificate, the registered lien exceeded $178,000, and the property owner discovered the encumbrance only when they attempted to refinance, not when they were notified by the CRA directly. Stay with me, because the refinancing angle is where this gets even more surgical in its destruction. You cannot refinance a property with a federal tax lien on title. No institutional lender in Canada, no Schedule A bank, no credit union, no mortgage investment corporation operating within conventional underwriting standards will advance new funds against a property where the federal crown holds a prior claim. The lien is, by its nature, a priority encumbrance. Depending on its registration date and the structure of your existing mortgage, it can sit ahead of or immediately behind your primary lender in the priority stack. Either way, no new lender will step into second or third position behind a CRA charge of unknown and growing magnitude. Your existing lender, when they discover the lien at renewal time, will view it as a material change in the security position of their loan. That is a trigger. That is leverage, and some lenders, depending on the language in their mortgage commitment, can call that a default event, not because you missed a payment, but because the security they lent against has been compromised by a federal claim. So let's map this precisely. You received a reassessment, you filed an objection. You believe you are protected. Here is what the objection actually does and does not do. Filing a notice of objection under the Excise Tax Act does, in some circumstances, provide a statutory hold on certain collection actions. The CRA's general administrative practice during an objection period is to pause active collection enforcement, wage garnishments, bank account levies, direct seizure actions. That is the protection people cite when they say, file an objection immediately. And it is real. But there are two critical limits to that protection that most people, and frankly many generalist accountants, do not articulate clearly enough. First, the hold on collection actions is not automatic in every case and does not apply in all circumstances. The CRA retains discretion to proceed with collection even during an objection period if they believe collection is at risk, if they have reason to believe the asset might be transferred, encumbered, or dissipated before the debt can be collected. In those circumstances, they can and do act. Second, and more importantly, the objection does not stop interest from accruing. The clock does not pause. While your file sits in the objections queue, which, depending on the complexity and the CRA's current processing volumes, can take anywhere from 12 months to several years, the arrears interest continues to compound daily on the full balance. Every month of delay is not a month of protection. It is a month of growing liability. But if you win your objection, the interest on the contested amount is reversed. But if you lose, partially or fully, you will owe not the original reassessed amount, but that amount plus every day of interest that accumulated during the entire objection and appeal process. The people who discovered this outcome describe it as watching a fire burn your house down while being told not to move. Now let's talk about the 5 things that need to happen. Not should happen, need to happen. From the moment you receive a reassessment notice that you cannot immediately pay in full. The first thing is to not go silent. This is the most common and most catastrophic mistake. People receive a notice, feel sick, and do nothing for 30, 60, 90 days because the number is too large to emotionally process. Silence does not pause the clock. Silence does not demonstrate good faith. Silence is read by the CRA system as indifference, and it removes any administrative latitude that a collections officer might otherwise apply. The CRA has discretion, but they only exercise that discretion in the presence of active documented communication. The moment you receive the notice, acknowledge it, in writing. even if you are contesting it. The second thing is to begin assembling every document connected to the transaction that generated the liability. Every receipt, every communication, every piece of evidence that either supports your position or clarifies the timeline. Not to hand over to the CRA immediately, but because if this escalates to tax court, the strength of your case will be determined entirely by contemporaneous documentation. Reconstructed records created months or years after the fact are consistently treated with skepticism. Original documents are your only real weapon. The third thing is to calculate the worst case scenario with absolute mathematical honesty. Take the reassessed amount, apply the current arrears interest rate, project it forward 12 months, 24 months, 36 months. Look at what the number becomes. Then look at your current equity position across every asset you own. Understand precisely whether you have the capacity to satisfy this obligation if you ultimately lose the objection or appeal. Many people discover when they do this exercise honestly that the gap between what they owe and what they can access is narrower than they thought, or far wider. Either way, knowing is the only rational starting point. The fourth thing is to be extremely precise about who you engage for professional help. A general practice accountant who prepares T1 returns and handles small business bookkeeping is not equipped to navigate a federal GST/HST reassessment under the Excise Tax Act. This requires either a tax lawyer with specific experience in CRA disputes or an accountant who holds a specialist designation and has actual file experience at the Tax Court of Canada level. The cost of engaging the wrong advisor is not just the fee you pay them, it is the time lost, the interest accruing, and the strategic errors made during a window when the right moves could have materially changed the outcome. The fifth thing, and this is the one most people resist because it feels like defeat, is to explore whether a payment arrangement with the CRA is available and whether entering into one provides any strategic advantage. A payment arrangement does not constitute an admission that the reassessment is correct. It can be negotiated while an objection is pending, and in some cases, entering into a formal arrangement can influence the CRA's willingness to defer more aggressive collection actions, including the registration of a lien. This is not guaranteed. It is not a legal right, but it is a documented administrative reality that collections officers have latitude to consider. And that latitude is far more likely to be applied to a taxpayer who is communicating, documenting, and demonstrating a plan than to one who has gone silent. Here is something that rarely gets said clearly enough. The lien is not the end of the process. It is a waypoint, but it is a waypoint that changes the mechanics of everything that follows. Once a certificate is registered and a lien attaches to your property, you are no longer navigating a tax dispute. You are navigating a property encumbrance. And those two things, while connected, require different strategic approaches, different professional advice, and a different understanding of your timeline. A tax lawyer focused purely on the substantive merits of the HST reassessment may not be the right person to advise you on the real property implications of the registered charge. A real estate lawyer handling the conveyancing issues may not have the depth to advise you on the tax dispute strategy. And the intersection of these two domains is where people get crushed, not because the law is unfair, but because they assembled the wrong team for the wrong problem. Let's be precise about what discharge of the lien actually requires, because this is a concept that gets used loosely. The CRA will discharge a registered certificate and the lien that flows from it when the underlying debt is fully satisfied. Full satisfaction means the entire outstanding balance, including all accrued arrears, interest, and any penalty amounts, has been paid. A partial payment does not discharge the lien. A payment arrangement does not discharge the lien. A successful objection that reduces the underlying assessment will reduce the lien, but until the reduced amount is also fully paid, the charge remains on title. If you sell your property during this period, the discharge will happen at closing through the direction of proceeds, but you will not control how much of your equity survives that process. There is a variation of this story that plays out in a particularly brutal way in the pre-construction assignment market, and it deserves to be addressed directly. An investor purchases a pre-construction unit intending to assign it before closing and capture the appreciation without ever triggering occupancy. The assignment closes. The investor collects their profit, They believe the HST obligation, if any, sits with the buyer who completes the purchase. The CRA disagrees. They assess the original investor, not the ultimate purchaser, for HST on the assignment transaction, but on the basis that the investor was in the business of buying and selling real property, making the assignment a taxable supply. The assessment arrives 2 years after the transaction. The investor has already spent the profit. The property they assigned is no longer in their name, but their current primary residence, the home they live in, is, and that is the asset against which the certificate is registered. That is the lien trap in its most precise and most devastating form. Liability generated by a property you no longer own, collecting against a property you live in. This is why the sequence of decisions made between receiving a notice and the CRA taking action is not a matter of weeks. It is a matter of days. The administrative timeline for the CRA to move from notice of assessment to federal court certificate registration, and particularly in cases where they have assessed the risk of collection as elevated, can be compressed aggressively. Taxpayers who believe they have months to figure out their response have discovered that the certificate was registered while they were still in their first conversation with a generalist advisor. The architecture of this system, the self-supply rule generating the original obligation, the interest accrual beginning at the point of original due date, the objection process providing incomplete protection, the lien mechanism requiring no court hearing, and the discharge requiring full payment is not accidental. It is designed with a specific logic. The logic is that the federal government is a creditor unlike any other creditor you will ever encounter. They do not need a contract with you. They do not need a judge to agree with them before they act. They have statutory authority that was deliberately constructed to be fast, hard, and difficult to reverse. Understanding that architecture, not fearing it, understanding it, is the only rational response. In our next investigation, we are going to pull back one layer further and examine the rebate mechanism that was available to many of the people who ended up with these reassessments, and specifically the filing deadline that, if missed by even 1 day, permanently eliminates the ability to access that rebate. We are going to look at documented cases where the difference between a 6-figure liability and a manageable outcome was a single form filed within a specific window that nobody told the investor existed. And comment below, tell us whether you want us to cover the new residential rental property rebate first or go straight to the assignment-specific rebate rules. Drop A for rental rebate, B for assignment rebate. The answer determines what we investigate next. If this channel has ever made you think twice before signing a document, before accepting advice from someone who is not a specialist, before assuming that the way you structured a transaction was clean, then you already understand why this work matters. The system is not designed to warn you. It is designed to collect. Subscribe, turn on notifications, and stay close, because the next trap is already in the pipeline, and it does not announce itself in advance.